is Kugan, and together in this team there is 6 of us, which is Kurubaran, Malini, Mageshwaran, Dineshwari, and Nur Fatiha. We were given topic 2, Islamic capital market response to the crisis. So I will be doing the first part of the discussion, which is discuss the impact of global crisis on the Islamic capital market. So what are the impacts? Actually, in the Islamic capital market or the Islamic banks, they can be categorized into two types that has been affected. One is the Islamic banks that have been affected directly, are those banks that have had investments in global stocks through international investment portfolios and international investment funds. And the other type of banks that are affected is the banks that are affected by the crisis indirectly as a result of the impact of the crisis on all sectors of the economy without exception, to variation decrease, knowing that the financial sector and the banking were the most affected in the crisis. But out of this crisis, you can see there's positive impacts and negative impacts. So we're going to first see the positive impacts on the crisis on the Islamic capital market or Islamic banks. First is the recognition of the international community for the Islamic banks and makes room for them to work and even internationally recommending them, because as later we discuss the different types of risk, we will understand that Islamic capital market survived the financial crisis. Second is converting many of the conventional banks to Islamic banks, and the conventional commercial banks starting to open branches for Islamic transaction as well as windows of Islamic banking, as mentioned in part 1. The third point would be increased activity of conference, seminars and research centers dealing with Islamic economy in general. The fourth is some of the universities has established schools to graduate students specializing in Islamic economic, including specialty in Islamic banks. Number 5 is the increase in deposit of Islamic banks after the crisis, influenced by several factors, which includes many customers shifting from deposit with the conventional banks to Islamic banks, the establishment of Islamic banks in various countries around the world, the establishment by some conventional commercial banks for Islamic branches, and the trend of governance in the world to benefit from the basic Islamic banking, from Islamic banking to be seen part of a solution to current banking, global financial crises, and lastly, increasing use of Islamic financial instrument both at the level of private sector and the level of government and public institution, local council, and clearly points to the possibility of Islamic banks to be a complete substitute for conventional banking throughout the development of Islamic financial instrument. So these are all the positive impacts that came out of the financial crisis towards Islamic capital market. My friend is going to share all the negative impacts. Thank you.
And Malini, I'm going to discuss about the negative impact of the crisis on Islamic banks. So the global financial crisis negatively affected Islamic banks directly and indirectly. And among these effects, the first one is it's reduced the asset of Islamic banks due to lower customer deposit affected by lower economic activity, and also affected the right of private ownership, especially retained earnings and reserves. The second one is the depreciation of the asset of Islamic banks, as the crisis has led to the decline of real estate asset worldwide, and thus the asset of Islamic banks were affected. The third point is Islamic banks are forced to cut allocation to meet the large depreciation of asset, which also had impact on the profit and reserves. Also, some customers faced bankruptcy and problem by the crisis have made the Islamic banks deduct more of the provisions. Continuously, a decline in net profit of Islamic banks. The reduced entry of Islamic banks lowered the return of asset as a natural result of low economic affected by the crisis. The sixth point is high operating cost as a result of restructuring activity and then restructuring the income of expenses. Second, followed by lower return on equity due to lower net profit. The eighth point is Islamic banks were affected by recession, which happen to the countries where there are activities for those banks. Continue with the accumulation of liquidity in some Islamic banks as a result of their inability to employ them. The last one is Islamic banks are forced to restructure their revenues and their uses in many ways. Thank you.
Let's move on the second part of the presentation. So basically on this part, we will show how Sharia prohibition may have helped to avoid or minimize financial market crisis. We will look into 2007 and 2009 global financial crisis as an example. It started in the US and spread across most of the developed world, and lots has been written about the cause and nature of this crisis, but the key story centers around major investment banks that over-leveraged themselves using mortgage-backed securities. This crisis was triggered by the advent of the subprime mortgage crisis in the United States that became apparent from the mid-2007. So basically, Sharia prohibition actually can avoid or minimize this crisis by providing a guidelines for the user in the decision-making process. So this guidance will streamline particular process according to set of routine or sound practice. In this case, Sharia compliant transaction means that almost all the transaction that is not Sharia compliant should be avoided or aborted by the people. First is Sharia prohibition provide the rules to either proceed with the transaction or abort it. In this case, we will discuss specifically on interest. Interest basically making excess money out of money or a loan that we give to the borrower. So if we follow Sharia guideline, in case of deciding of permissible transaction in Islam, investor should automatically drop the transaction that involve interest in it. Based on Ilasraq, one of the main reasons for this global crisis is the dependence on interest-based loan given as a basis in a funding. So fundamentally, we can say that the stimuli or motivation from the overall transaction that caused this global crisis is making money out of money or charging interest rate on the loan. As mentioned previously, the key story that centered this global crisis is mortgage-backed security. So basically, this security began with Party A expressed its intention to purchase a home. For example, 100k from a dealer. However, Party A does not have money to proceed with this purchasing, so he approached Bank B to help him financing this transaction. And Bank B sees this as opportunity to make income and agrees with the transaction, provided that Party A will pay 5% of annual interest rate to Bank B over 30 years of tenure. So to officiate this transaction, Party B issue a piece of paper which we call mortgage, and Party A will get his house. However, Bank B cannot afford to wait for another 30 years to get all of its money. Thus, Bank B sells all of this mortgage to Bank C, which is in this case is investment bank. Bank C buy this mortgage because they can anticipate an opportunity for them to make money from the mortgage from the Party A through interest rate with a chance of earning of 5% of interest rate from this mortgage. Bank C not only purchases a loan from Bank B, it also buys this mortgage from other banks. For example, Bank C buys 100,000 unit of USD 100k loans from other banks with 5% of interest rate. So the total anticipated income that Bank C will earn is USD 5 million a year. This transaction seems profitable to those parties who involved as well as to potential investors. Even so, Bank C is not going to hold accountability for this mortgage also. They cannot afford to wait for 13 years, for 30 years to get all their money. So Bank C create another company which we call Corporation D and place this mortgage in the company. So the earning of the company depends solely on the interest made through the loan, which is 5 million a year over 13 years. Now, we can see that the company's Corporation D seems stable and profitable in the eyes of the investor. So investors are interested to invest in Corporation D. So to facilitate this transaction, Bank C issued a securities which we call mortgage-backed securities to the public with interest rate of 5% and recover its initial investment from buying the loan. So based on the process outlaid here, the intrinsic stimuli that motivate this type of process is the ability to make money from the money itself. Bank B lends the money to party A with the opportunity to make money from the borrower, but Bank B cannot afford to wait another 30 years to get the money. So Bank B sold this mortgage to Bank C. Because Bank C see that the opportunity to earn 5% interest from this transaction, they buy the mortgage from Bank B. But they also will not wait for another 30 years to get the money. So to help this one, they create another corporation, which is Corporation D. And the investor also buys this share with an opportunity to make money from the investment. Therefore, if we apply the guideline from the Islamic finance, this kind of activity should be already eliminated on early stage of decision making, as it is prohibited in Islam. Thus, Bank B will not sell this mortgage to other banks, and Bank C will avoid entering in this kind of transaction. On top of that, party A will not approach Bank B to get this loan. Consequently, this fundamental transaction will not take place in the process, which caused this global crisis.
Okay, so I'm Kumar. I'm going to talk about the next part of the Sharia prohibition. So Sharia prohibition, okay, it provides a guideline to minimize risk of transactions. Okay, so when we say minimize risk of transactions, what are we talking about is that we still want to proceed with the transaction, but we want to minimize the risk. So when we minimize the risk, we want to proceed with the transaction, but there will still be some procedures, to make it Sharia compliant. Okay, so we have to follow that. Okay, so in this Islamic finance, commercial uncertainty is allowed, but the uncertainty of the key term of the transaction is not allowed to a certain extent. Okay, for example, from what we put in our report over here is when customer A goes to bank B to get a loan, the bank does a full background check on customer A to see whether he's able to do a payback to the loan, like a credit score check and stuff like that. But during the global crisis of 2007 to 2009, certain banks like Bank C, for example, started to give out loans to people who didn't pass the first time around for the loans, for housing loans we are looking at exactly. So in this, it increases the risk of payback of the loan, but in Sharia prohibition way, the loans are still not given out due to the risk of payback of the loan. Yeah, so the next part will be continued by our next team member. Thank you.
Okay, now I would like to explain on the risk management practices in Islamic capital market that could be helped to avoid or minimize the crisis. So first we will go with market risk. In Islamic capital market, intermediaries may be exposed to the market risk due to the changes in the market prices, as well as the execution risk, which may be impede a quick enough action to avoid incurring loss. Market risk could also arise due to market to market, which may not be risen while taking a position in an investment, but may nonetheless be publicly recorded in ICM intermediate account. This is in addition to a model risk that may manifest as another form of market risk due to the Islamic capital market intermediaries' use of models in the tradings in illiquid or thinly traded assets. But credit risk also arising from outstanding receivable from the provision of services is managed by accepting service engagement from only well-known and highly reputable entities and counterparties, whose liquidity is also subjected to a continuous monitoring to mitigate against the credit risk, which we earlier mentioned before, arising from the outstanding receivable from monitoring services rendered by the Islamic capital market intermediaries for the clients. Apart from this, we have another operational risk as well, which considered the third in the list. Operational risk is also mentioned by the Islamic capital market intermediaries as being prevalent in their intermediation activities. As in the case of conventional capital market intermediaries, operational risk occurs as a result of losses incurred due to the inadequate or failure internal processes, people, and system on the one hand, or lastly to the exposure of the ICM intermediaries to the external events on the other. It could be related, for the instance, the online or investment platform could be down. This may have the implication in relation to the execution of the transaction and their settlements, publicity, and legal implication from any dealing between Islamic capital market intermediaries and the third parties. An Islamic capital market intermediary indicated that in addition to an oversight function by internal audit or risk committee, it's also engaged external independent auditors. All these mechanisms are intended to keep in tune with the best practices and to take into consideration lessons learned from publicized operational failures within the financial services industry. For other three components of the practices, my teammate will explain further on it. Thank you. Secondly, I would like to explain on the credit risk. In the Islamic capital market intermediaries, exposure to credit risk may also due to the failure of counterparty to honor obligation as they fall due. Operationally, credit risk may also manifest either as clearing risk or custodial risk. In the case of former, an intercapital market intermediary fails to accurately record trades executed in its book. In the terms of latter, an ICM intermediary as a custodian may be exposed to such a risk if it co-mingles whether in a cash or security with the investor fund, which may not be available in the event of insolvency. In some cases, credit risk arising from the balance with investee companies is managed by placing funds as such company having appropriate reputation or credit ratings.
Hi, I'm going to continue on three more risks that we discussed on how risk management practices in Islamic capital market. The fourth risk we identified is liquidity risk, which mentioned as manifesting in the lack of depth of the Islamic capital market. As such, asset may have to be kept to maturity in some instances, which may exacerbate their exposure to concentration risk. In some other instances, Islamic capital market intermediaries monitor liquid assets and their requisite cash requirements on a periodic and regular basis. The fifth risk is Sharia non-compliance risk. Such risk may arise in instances of status transformation due to continuous updating by the RSA, in which case a stock previously categorized as being Sharia compliant may be otherwise classified as non-Sharia compliant after funds have been committed to it by an Islamic capital market. Another instance highlighted in the survey is where an investee company takes on a non-Sharia compliant financing or funding, or where an issuer of a previous Sharia compliant security has its status revoked due to its acquisition of a non-Sharia compliance businesses. The last risk we're going to see is other general risk. Type mentioned include legal risk, which in Basel taxonomy may also be viewed as a form of operational risk. It may arise if an Islamic capital market is sued for its inability to effect its own part of a contractual agreement, or
for practices that infringe on the right of a counterparty. In addition, a few Islamic capital market intermediaries noted their susceptibility to money laundering and financing of terrorism risk, in which case transaction flows may be diverted to uh, open venues. That's all from us. Thank you.